Welcome to this explainer. If you've ever actually looked at a company's financial records, you probably already know a little secret. The numbers rarely do exactly what you want them to do. Today, we're basically putting on our detective hats. We're going to explore this really fascinating investigative tool known as variance analysis. It is literally the ultimate framework managers use to uncover financial truths and figure out exactly what the heck happened when the numbers just don't go according to plan.
Think about it for a second. Why do budgets almost always fail to predict a future perfectly? You sit down, you build this incredibly detailed, well-thought-out plan for the year, and then by quarter two, reality has completely shattered your expectations. Your costs are way up, your sales look completely different, and everybody is looking around asking, why? Well, that specific pain point, that gap between what we expected to happen and what actually happened, is exactly why we need a specialized toolkit. We need a rigorous mathematical way to investigate these failures.
Okay, let's dive into this. Here is our clear roadmap for decoding the mysteries of budgeting today. 1. Expectations versus reality. 2. Favorable or unfavorable. 3. Decoding revenue and costs. 4. The overhead enigma. And 5. The human element.
Let's start with Section 1, Expectations versus Reality.
So, what is variance analysis, really? It's a managerial accounting technique, and its entire purpose is to compare your budgeted figures with your actual results. The goal is to identify, measure, and explain the differences, which, in accounting speak, we call variances. Think of it as your ultimate diagnostic tool. It's an absolutely key mechanism for planning, for maintaining control of your operations, and for objectively evaluating performance across the whole organization.
But why do we actually do this? We aren't just calculating these variances for the sake of doing math, right? The purpose is highly practical. We use it to monitor how well actual performance is aligning with our budget as the year rolls on. It helps us spot hidden areas of inefficiency or, on the flip side, unexpected improvements that we might really want to replicate. Most importantly, it supports managerial control and corrective action. We investigate these variances to find the truth and fix problems in real time, which ultimately makes our future budgeting that much more accurate.
Moving right along to Section 2, Favorable or Unfavorable.
Now, what's really interesting about this is how simple the baseline is. Every single variance falls into one of two buckets. A favorable variance simply means your actual performance is better than what you budgeted. For example, if your actual costs turn out to be lower than your budgeted costs, well, that's favorable. On the other hand, an unfavorable variance means your actual performance is worse than budgeted, like if your actual costs ended up being way higher than planned. It sets the immediate tone for whether a manager needs to be high-fiving their team for an efficiency win or investigating a serious cost overrun.
All right, Section 3, Decoding Revenue and Costs.
Let's start right at the top of the income statement with revenue. The overarching sales revenue variance is pretty simple. It's just your actual sales revenue minus your budgeted sales revenue. But as you can probably guess, that single number doesn't tell the whole story. If your revenue is down, you really need to know why. That's exactly why we break this down further into two distinct analyses, the sales price variance and the sales volume variance. Doing this tells us exactly whether the drop happened because we had to lower our selling prices to stay competitive or just because the physical volume of items we sold shifted.
Let's look at how this builds when we evaluate our costs, specifically direct materials. Just like with revenue, one big total cost variance isn't enough info. So we split it into a price variance and a usage variance. Look at the price variance formula. Actual price minus budgeted price multiplied by the actual quantity purchased. This answers a very real-world question. Did our purchasing department have to pay a premium for materials? Then look at the usage variance. Actual quantity minus budgeted quantity multiplied by the budgeted price. This isolates the factory floor itself. It asks, regardless of what we actually paid, did our workers waste materials or did they use them efficiently? By separating price from usage, we know exactly which department we need to go talk to. And we apply that exact same logic to the people side of things with direct labor variances. We split this into a rate variance and an efficiency variance. The rate variance takes the actual rate paid minus the budgeted rate times the actual hours worked. This basically tells us if HR or management had to pay a higher hourly wage than expected, maybe because of market shortages or lots of overtime. The efficiency variance takes actual hours minus budgeted hours multiplied by the budgeted rate. This connects directly to the reality on the floor. Were our workers just less productive with their time than we planned? Did a machine break down and cause them to stand around? Again, we are isolating the specific root causes of the cost deviation. It's brilliant.
Section 4, the overhead enigma.
Now, overheads can be tricky. So to tame all that complexity, we don't just lump all our indirect costs into one giant pile. Overheads are divided strictly into variable and fixed categories. For the variable overheads, costs that fluctuate with production, we look at the spending variance and the efficiency variance. For fixed overheads, things like factory rent that don't change regardless of output, we look at the fixed overhead budget variance and the fixed overhead volume variance. By maintaining this kind of structure, we can pinpoint exactly where our indirect cost control is slipping without getting totally bogged down in the massive aggregate numbers.
And finally, Section 5, the human element.
Okay, this right here is perhaps the single most important rule in managerial accounting. When investigating variances, determining responsibility and controllability is absolutely critical. Managers should only be held accountable for variances that are actually within their control. Think back to our earlier examples. It is entirely unfair to penalize a factory floor manager for an unfavorable direct material price variance if, say, global supply chain shocks drove the price of raw steel through the roof. That manager controls usage, not global market prices. Recognizing the real limits of a manager's control prevents the whole system from becoming arbitrary and unfair.
Because if we ignore that rule, we're going to trigger some severe behavioral issues. When variance data is weaponized or misused, you will absolutely see three distinct negative reactions. First, managers will start making poor short-term decisions just to meet the budget, like delaying vital machine maintenance just to keep this month's costs looking low. Second, they'll create budgetary slack, which is basically sandbagging. They'll artificially inflate their budget requests up front so they are guaranteed to show a favorable variance later on. And third, you just get widespread demotivation if variances are used punitively rather than constructively.
So the crucial point to take away is captured perfectly right here. Variance analysis should be used as a diagnostic and learning tool, not purely for criticism. The true managerial goal of this entire toolkit isn't to point fingers when expectations don't perfectly match reality, it's to learn about your business operations. It's about asking why with genuine curiosity rather than accusation so you can adapt, improve, and make your organization stronger and a whole lot more efficient going forward.
I want to leave you with this final provocative thought. Look at your own organization, or even just the next financial report you sit down to analyze. Ask yourself, are you using your budget and the resulting variances as a tool for learning and improvement? Or are you using them as a weapon for criticism? How you answer that question entirely changes how effective variance analysis will actually be for you. Thank you so much for joining me on this explainer, and keep asking the right questions about your data.